idea from thetraderguy.com for the upcoming June 10th week in the Forex world. I have the dollar yen in front of you. And as you can see, obviously, unless you've been asleep for several months, lost at sea, or whatever, you know that the dollar yen pair has been where most of the action in the Forex markets has been recently. On Friday, we had the non farm payroll number. Came out a little bit better than expected. Off the top of my head, I think it was supposed to be 165. It came out, or it was supposed to be 170. Came out 175. Generally within consensus. Um, some of the months previous were revised down slightly, so it was by the time it was all said and done, it was pretty much the same as coming in where it needed to. So having said that, we had an interesting reaction, which I believe originally was, well, maybe the Fed is not as close to tightening as people had thought. And you can see that the market crashed right down into the 95 handle, which was an area, as you can see, number one, it's a large psychologically significant number, but it's also an area that's acted in even in the longer term charts. When you go back, you can see 95 has been important a couple different times. We crashed into it and bounced immediately from it. Matter of fact, I think the low was about 94.91 or something, and then we just shot straight up. Bounced 2.5 handles by the end of Friday, forming a very big hammer, which of course is a bullish sign. On this chart, I'm not a big EMA trader, but the 100 day is one that a lot of people will pay attention to. And because of that, sometimes when I'm looking at setups like this, what I'll do is I'll try to find other reasons to be involved with the move. And what I mean by that is, originally when I would have taken a look at this chart, um, I would have personally had the chart looking like this, just a nice clean chart, 500 pips or so apart, and just see what we come up with. You can see that there's some symmetry to this market. The next thing I might do, start looking for trend lines. You can see I make a trend line there. And we had actually broken it at one point during Friday, bounced back over it, so obviously that held up. And then I might even take a fib. I'm actually kind of doing this on the fly, so I suppose I could take it from here. And we stopped, or we bounced back to the 23.6. You could make an argument out of that, I suppose. Really nothing too exciting. You could also say, well, what about this pullback? And this is kind of the underlying problem about Fibonacci retracements right here, is the fact that, okay, well, you can start it from a lot of different places, and voila, you have 50%. Um, so you can make that argument as well. But essentially, for me, just the shape of the candle and where it was enough. And then I start pulling these indicators out, 100-day moving average. It's interesting. You can insert another moving average. The 200 is fairly popular as well. Click on that and say, okay, that doesn't mean anything. So let's change that to the 50. Okay, well, that's not really doing anything but showing that perhaps, it's already been broken down, so it really doesn't show much. So at the end of the day, I tried a bunch of different things on top of what I had already seen with the trend line and then the obvious number and the nice shaped candle. So the idea is I'm trying to pour on as many reasons to be long in this market as possible. And because of that, and because of the shape of this, I think that this is probably where the action is going to be again. Will we shoot straight up? I don't know about that, but I certainly think that this market sold off far too much in a couple of days, and as a result, a lot of the people who had missed out on some of this rally or had gotten spooked out at one point or another saw this and thought, hey, this is a pullback we've been waiting on. And the fact that 95 held up so firmly at this point in time, I have to believe that 95 is a bit of a floor in the market. Now, On the other hand, one thing that should be kept in mind is the fact that the BOJ suggested that this was a range that they were comfortable with. So once it hit the 95 area, it was trying to break through the bottom of the BOJ's comfort level. I'm not saying the BOJ had anything to do with the bounce. I think what it was, quite frankly, is probably just a lot of hedge funds and such who knew that, kept that in mind. Probably had a ton of buy orders down at 95, and that was that. So we have a nice hammer. We're right at the 100-day moving average. Um, this is the 2 hour candle. Those of you in North America know what I'm talking about for Sunday. And then we've just flipped over. And as you can see, this market basically has gone back and forth, but it did gap higher. Not much, but a little bit. So it's already showing the proclivity to go higher. I think, once we get above 100, it can get interesting. It might be a bit choppy, but this looks more like a long term trade setup just waiting to happen.